everyone, and thanks very much for joining us on this journey into the dramatic world of crypto derivatives. Now, the term crypto derivatives probably sounds very technical and far removed from the daily hustle and bustle of blockchain development, but actually they are a very strong motor for the innovation that's going to help the financing and flow of funds into and around the sector. Today, we're going to look at the evolution of crypto derivatives and the impact they can have on the underlying market and where all this is going. And to do that, I'm joined by three experts that have spent some time looking at this concept, both in traditional finance and in the crypto world. I'm joined by George Pullen, the senior economist at the CFTC in the middle. On the far, we have Matt Trudeau, the chief strategy officer at crypto exchange RSX. And on my left, we have Max Boonen, the founder and CEO of market maker B2C2. Thank you all, seriously, so much for being here.
Thank you. Thank you for having us.
George, let's dive right in. At the CFTC, you have a unique top-down view of the impact that derivatives can have on the market of the underlying asset. So in terms of market maturity, where is crypto today?
Sure. So I got to start the way that all federal employees have to start before they make their remarks, which is these remarks are my own. They don't necessarily reflect those of the commission, the commissioners, or any particular department. I'm actually here for our outreach today. So I'd say the way that you should look at derivatives as they apply to this space is it's a natural progression and maturity that comes in all markets. When you look at the size of just the hardware that's behind securing the Bitcoin network, you're talking about estimates somewhere, the last time I looked, in the $50 billion range. With that size of investment, people want to hedge those risks. And so derivatives on top of those markets is a natural progression.
And a necessary progression as well.
Correct. People want to hedge their business risks, and they use commodities markets and then the derivatives on those commodity markets to do that.
When did the CFTC start looking at cryptocurrencies?
So I know as staff, a lot of people are just like myself. We're geeks, lifetime geeks. And as far back as 2013, we were definitely talking about it at our levels, reading about it in Wired and other places.
2013?
Mm-hmm. In 2014, we had our first public meeting. At the time, we had acting Chairman Weejan, and Ted Cervini was in charge of one of our advisory committees. That was a public meeting. You could go look it up on YouTube right now if you wanted to. But as far back as 2014, we had public meetings about it. And of course, through 2015 and 2016, more conversations, people coming to us, the exchanges coming to us, and then, of course, ultimately consummating with the listing of the futures contracts for Bitcoin that people are familiar with today.
And
so it's been a long time.
Why did you decide to pay attention to this? Because I imagine you get a lot of technical innovations thrown your way and you can't pay attention to everything. Why this? Why was this something worth dedicating resources to?
I think both the tone from the top is important to keep in mind. And I also think when you look at what this could mean for broadly the tokenization of commodities, so there's a lot of talk at the conference of STOs. I prefer the T to be in front of the S because you can tokenize a security, you can't securitize a token, but that's neither here nor there.
That's a different panel.
That's a different panel. But tokenized commodities or other innovations in that space are inevitable if you look at the progressions that we've had. And so staying on top of those innovations is important. And so we've been in a listing mode, and we've been here really strong this year. We had Road to Consensus. The chairman made remarks in support. We had Commissioner Quinten's Coin Center on Monday. Our fantastic director of Lab CFTC had a panel yesterday, Dino Gorfine. We've got Whistleblower, booth 145. They're here somewhere. I'm trying to help them out. There we go. They're here on the floor. We've got lab office hours in our New York office.
And you're here with us.
I'm the closer, yeah. So it's good. It's good.
Max, you've been making markets in cryptocurrencies since 2015. Is that right? So you've also seen your fair share of ups and downs. Where do you think crypto is today in terms of market maturity?
I think it's actually very early days because there's one problem I think I keep coming back to in crypto is that there's a strong enough spot market for the Delta One exposure, so to speak, but there still to this day is not a decent funding / credit market. And I find that very difficult because in my opinion, when you look at conventional markets, there's always a very strong interplay between the derivative markets and the spot market, between the funding markets, between the two. You look at the FX futures on the CME, they exist and are liquid because there's a strong link with FX swaps. between the spot FX market and the futures market. And the FX swaps in the middle, the funding market, is really one thing that is missing, sorely missing in the crypto market, because everyone's just naturally more excited about the price going up and down. And you don't necessarily want to hear about, interest rate differential between crypto and yen or dollars, and just not that exciting. But that's what I used to do when I was working, at a bank. And so naturally, I'm more interested, and I can see that, a lot of people are coming to this market with the, from the, not necessarily the wrong angle, but there's always something that's missing, and to me, that's credit and funding. People have been talking about custody. I think that's more or less a solved problem, in my opinion, at this stage. But credit and funding, this is still, a long way off.
And what's needed to fix that?
So essentially, the way that the crypto market started out is that you had those exchanges that are really clearing houses at the same time. And so you deposit your funds there, and then you trade, and then the settlement happens there. The reason they had to do that is because there was no way around that. You had to have the funds before the trade. It had to be fully funded, because you don't trust like random retail individuals to do trades with you and then settle and make good on the money, right? And so the exchanges were always like the Mt. Gox at the time, and then Bitstamp and so on, clearing houses and exchanges at the same time. But that model cannot lead to a liquid market. You always need a separation between the execution venues and the clearing. And that's the piece that's missing at the moment, because those big exchanges have acquired a critical mass. But it doesn't need to be like that. And one of the main market makers on the CME, and what you find is that on the CME, if you want to trade, is very conventional. So you have the CME, which is the execution venue, but then you need your clearing broker, you need your FCM. And I think that's a more, it's actually a more natural model. Economically, I think that any market will tend to sort of coalesce around separation between execution, clearing, and settlement. And I think that's just not something that's happening in crypto market, because the critical mass that the exchanges have acquired have kind of, I don't want to say slowed down that evolution, but surely it wasn't needed up to now, I would say.
Because it's a retail first asset.
Yes.
And I would add, just to economic geek out for a second, because I agree with some of your thoughts, is that if you look at also price discovery, a lot of times it's the derivatives markets, it's the futures markets where price discovery is happening for other asset classes. And so that becoming a natural progression in this asset class is also another fundamental economic component for its maturity.
Absolutely. And at the moment, price discovery in crypto is not in the derivatives. Importantly,
Correct.
When you look at the futures basis, they are extremely volatile, much more so than would be warranted by the sort of by normal liquidity conditions.
Yes, and especially in more mature markets as well.
Right.
Matt, RSX recently launched their spot market, and you have derivatives in the pipeline. Where do you see the institutional demand mainly coalescing, around derivatives or around the underlying asset?
So I think depending on, institutional is a fairly broad term. So I think we have to be more specific about what we mean by institutional, and there are different use cases. So, for example, talking about some of the other commodities markets, I spent some time looking at the gold market, and there are quite a lot of commonalities between the gold market, futures and spot market, the physical market, and let's say the Bitcoin market. So on the production side, if you've got institutional producers, the mining companies, for example, then futures have a specific use case for them in terms of hedging the risk and helping to smooth some of the price fluctuations around the cash flow from the production. Then you've got market makers that may be looking to hedge and offset risk, and then you've got institutions that just want to be long the underlying. So depending on which institution and which use case, they may gravitate towards one or both of those products. So I think it really isn't just one or the other.
The markets that we've seen, these like derivatives that we've seen so far on the regulated exchanges in the US anyway, they've been cash settled. You're talking about physically delivered derivatives. Why those when it involves the extra complication of custody?
So, I don't know that if you do custody correctly, it really adds any complication necessarily. So maybe up until fairly recently, that might have added a layer of complication. But I think we may have solved that now. So in the case where somebody wants just exposure to the price, then a cash-settled futures contract may be appropriate. But there are a lot of instances where the end investor actually does want to take delivery of the physical, does want to own the physical, and that could be as the underlying for another asset, potentially to the extent that we have ETFs at some point, or somebody just wants to be long the underlying. So in that case, a futures contract that does deliver physical is actually more attractive. That said, even in the markets, for for example, again, going back to gold, the vast majority of gold futures contracts don't go to physical delivery. They get closed out ahead of time.
Yeah, I was going to ask you, George, about that. What other commodities have a heavy physically delivered derivatives market on top of them?
Correct. So historically, most commodity markets have a physical delivery component. This isn't a value judgment on physical versus financial delivery. This is just historically how they've evolved. Oftentimes, it's the I hate to use the word threat, but it's the possibility of physical delivery, to use a different term.
I like the term threat, though. It's kind of like,
oh my
God, I got a bunch of cows
I don't
at my door.
saying the word threat, right?
Where do I put this corn?
It's the possibility of physical delivery that helps price convergence. Price convergence is, of course, to not go too far down the rabbit hole, is where the price of your derivative contract and the price of your physical commodity, so in this case we're all talking about virtual currencies, they meet each other and they're strongly correlated. And you want to have that, and so having a physical delivery component historically in many markets has helped produce that. So oil, gold, et cetera, that's a component of those markets.
And Max, you mentioned price discovery. Physically delivered derivatives would have a stronger impact on price discovery?
I think what George's explanation was very good, but in reality to me it doesn't matter that much because you've got very big derivative markets or cash sets. So I'm looking at Euribor futures, Eurodollar futures, right, and no product is perfect. You know that some good, some bad, but you've got, those markets are cash settled, they're fine. You've got, when I was at Goldman, I traded bond futures, you can deliver into the bond futures, that also works, but you just need to manage them, slightly differently. If you have cash settlement, you need to have very strong governance around what is then the index, it settles again. And then if you've got physical delivery, you have other sorts of problems. Yeah, I remember on the desk, only a few people could go into delivery because it's got its own, risks and problems. What happens if you get delivered a bond or you need to deliver a bond but you don't have the bond, then you have a settlement fail and you start having penalties and things like that. So, I think different products suit different needs, and that's all it is. I'm not philosophically inclined one way or another, and I respect the fact that you're not either.
I imagine the characteristics of the underlying asset as well probably have something to do with that. With corn, with oil, with gold, there is a physical need for hedging. The producers actually need to hedge, whereas in crypto, yes, the miners have their needs, but the main use case has been speculation so far.
Well, surely there's, in all derivative markets, there's an important interplay between commercial hedgers and speculators, because if you only have commercial hedgers and they're all the same way, then that doesn't make a market, right? You need someone to be able to take the other side, and you don't always have a natural other side, right? So, you're going to have hedge funds that have sort of like relative value plays, or they think that the curve is too steep or at too much of a discount, they're going to take the other side. That actually helps the commercial hedgers, right? Because if no one else were to take the other side, the price would not be as good. So the fact that the crypto market is very much speculative at the moment, I don't think that's bad. I think that's where it is right now. It may be different in the future, but it can the fact that it's very speculative can also bring about stronger liquidity for commercial hedgers.
Bring in the money.
If I could just add to that. A diverse market, it's really important to have a variety of different players with different views over different time horizons. And some of those speculation plays a role in that. And then you've got fundamental investors that have a slightly different view. And then you've got market makers that are providing liquidity and have a need to hedge in more real time, potentially than, let's say, a longer term investor. So to have a really high quality market with deep liquidity, you need all those different players that have then the tools to express their different views across different time horizons.
Right, generally speaking, if you look at futures markets and derivatives broadly, it's helping people become matched who are different natural participants and commercial participants, along with people who are making markets. And what that happens, and the way that happens most effectively, is the derivative allows them to transform across time and across space, and across types.
Dimensions.
Dimensions, right. So across time, maybe I need to settle right now. Maybe I have a real need for cash from my mining operation, right? So I'm going to go back to fiat to translate. Maybe it's across space. So maybe it's from one location to another of operations, and then across type. So maybe your exposure isn't to the underlying derivative, maybe it's to a closely related derivative, and you're comfortable with that basis risk. But that's a typical factor in all futures markets.
Yeah, and the texture that becomes evolving. But when it comes, especially I imagine, to cash settled derivatives, Mac, maybe you want to take this. cash-settled derivatives is very much like any other cash-settled derivatives. It doesn't really matter what the underlying asset is, and it's something that traders, professional traders, are familiar with. Do you see them regarding this as just another asset to make a profit on, or do you see the institutions that you talk to, the traders you talk to, care about the underlying story?
I think that when you have, you hear noises from institutions that they prefer one or the other, it's typically because at the top someone has a philosophical inclination one way or the other.
They're geeks
Other
like
than
us.
that, I don't think they should be, they should mind, because if you're in the business of providing, you're an intermediary really, then you should cater to the end user, to what your client base wants. And I think that's what it is. Now the question is, does the general population or people who actually want to trade in or invest in crypto, do they want one or the other? I don't know that. I see my user base is not really does not really care one way or the other. And they're large institutions. What matters to them is that they're able to service in turn their own clients. And at this stage, what we find is that the biggest use case is that they want to be exposed to this asset class, which might, possibly change the world, and I have no opinion specifically on that. And that's what's important. The format itself is not that important, and that's why I keep going back to the problem of the funding market. We have those derivatives now, and I think the CME Pro is really working. That's great. You've got the spot market, but in between the two, we need to bridge that gap with the funding market so that the end users that need, for a reason or another, to convert between time and place, etc., they can do that through derivatives, or they can do that through physical trade, right?
Correct.
Because when you look at the foreign exchange market, you've got the FX futures and the CME, very liquid derivative, but most of the FX market actually happens in normal physically settled trade with every day what they call the Tom next roll, right? And that's kind of the same thing, but instead of being an actual derivative where you need to be connected to the CME, have an FCM, etc., what you need in the other case is just to be connected to a bank, right? So and some people can't connect to the CME, some people can't really connect to a bank or a prime broker, so you need to cater to everyone here.
And not picking winners and losers, we don't do that, but if you also look at other structures outside of FX markets, look at things like natural gas. Like in natural gas markets, the way that pricing occurs is there's the physical market. The physical market, touches a given molecule of gas, maybe 2 or 3 times before it reaches an end user. But then the financial market, the derivatives market that sits on top, that is several times larger, hundreds of times larger. So both systems have precedence, and both systems can work in different markets. It just depends.
Do you see crypto heading that way, where the derivatives will end up being hundreds of times larger, perhaps, than the underlying spot?
Are they not at the moment?
Oh, that's a very good question. In the regulated markets, I guess George can probably speak more to that.
But I'm always speaking about the regulated markets, so that's not a...
Matt, how do you see crypto evolving differently from the traditional assets in terms of the difference between the derivative markets and the spot?
I don't know if it actually will evolve that much differently. I think there are a variety of different market structures depending on which asset class you're talking about. One of the things I find fascinating about crypto is that in some ways it traverses different asset classes. It's global. It doesn't exist within, it's not defined or exists within a specific regulatory framework, so it's not like a security in that sense. It's more like a commodity like gold that can live in a variety of different geographic locations. It can move around in cross jurisdictions. So I think if you look at the characteristics of the asset and then you think about what characteristics overlap with maybe some existing assets, we might be able to pick and choose and draw from different market structures across assets to create something that makes sense for this, for the peculiarities of this specific asset class.
And we've heard many people compare crypto to gold, as you have, but what's the risk profile of the people that you talk to? Gold is a physical substance, whereas Bitcoin, for example, is a technology. And I heard this morning a wonderful line which says that no one's really worried that gold will mutate into lead while it's in the vault, whereas a technology can evolve and problems can emerge that we haven't seen before. Is this something that you're hearing, the risk involved in putting so much behind a technology?
I guess maybe the futures contractor, it's an interesting question because unlike gold or another physical commodity, you do have to have, potentially you would like to have some understanding of the level of the underlying technology. But we responded to, the CFTC put out an RFI with some questions about Ethereum. And what was interesting about that, and RSX submitted a response to that, what was interesting about some of their questions were they were deeply technical. So they got into a lot of questions about proof of work versus proof of stake. They got into a lot of what-if type scenarios. And as I thought about that, again, referencing existing markets for precedent, and looked at the gold market, the interesting question for me was, well, there's actually a lot of technology that goes into mining traditional commodities. So when you think about the mining and refinement of gold, let's say, there's electrolysis, there's just a lot that goes into that. But the market doesn't necessarily have to express a view on the risks related to the underlying commodity. They're expressing a view on maybe the price or the long-term investment value of the commodity. So I think in that sense, we're not getting any specifically technical questions about the risk. It's more about if we do express our view on this by purchasing the asset, do we know that it's in a place where it's going to be secure? Do we know that we can trade it on a place that has robust policies and procedures and transparency, where we can access price discovery? So I think the questions relate more to how do we best implement a trading strategy versus a risk about the underlying technology.
Okay,
I would add to that. I mean, we've put out several other pieces too around awareness of these technologies. So we have various brochures on the Bitcoin markets and virtual currency markets that come out of our outreach and educational offices. So hashtag DYOR. That's an important message that people need to hear. So although I'm not, hashtag. So while I'm not disagreeing with anything he said, I think that it's also important that people keep in mind that there are resources where they can do some of this education on their own and see just how complex even traditional commodity markets are.
Yeah, and at least get to the stage where you think you've done enough to be able to take a decision. As those of us who spend our time researching the sector, you never know enough, but enough to make a decision. Max, you operate in Europe, Asia, and also now the US, and you hinted at this a moment ago when you asked about the actual size of the derivatives markets. What cultural differences do you see in the approach to crypto derivatives?
Between regions?
Yeah.
Yeah. I think the regulatory regimes are different, but they try to achieve roughly the same aims. Now, the big piece in Europe is MiFID, and in the US you've got the CFTC. I think that a lot of names change, right? I mean, you've got CFDs in Europe and total return swaps in the US, but at the end of the day, they tend to achieve roughly the same aims. But obviously, one of the issues that, I mean, I don't know if it's an issue, perhaps it's by design, is that you need to replicate different regulatory setups across the globe, such that we're compliant in Japan, we're compliant in the US, and we're compliant in Europe. Yeah. But other than that, they're roughly similar.
I would add, just to differentiate ourselves a little bit, one of the things that we pride ourselves on, and that you'll often hear crypto dad making remarks on, is that we are a principle-based agency. And so that's an important differentiating factor. So
what does that mean exactly?
So to be principle-based is in contrast to being rule-based. Being principle-based means there might be a variety of approaches by which someone can adhere to our core principles. And that allows freedom of innovation, freedom to access different technologies. We've also had our KISS and our 21st Century Regulator initiatives that the chairman has spearheaded, and all those things sort of go around that same theme that, broadly speaking, we're both interested in these markets, but also, the larger stories about fintech and the larger applications of blockchain, even how they might be applied for us internally for regulatory purposes, and also how they might be applied more broadly across our current registrants.
If I may add, there are important values that are shared between regulators. I can name a few. Capital adequacy. So, and all of those values, we've had problems in crypto. Right? Capital adequacy. If the firm sort of blows up or has a problem, what happens to can they survive the downside events, and can they pay back the customers? You've got transparency. That's also been a bit of a problem in crypto, as we know. And then you've got suitability. Is this product the right product for a given person or entity? And so I think that the CFTC has an interesting approach. In Europe they have also a similar approach, and those are the core values. I think if you look at Western democracies, Japan included, that we're looking at, and I think it's very important that the crypto market matures and steps us to the plate and try to work on those sort of values, so that we feel confident that those products are the right products for the population.
And how important do you feel regulation is? I mean, obviously it's very important for the institutions to feel comfortable in this, but you do work in some jurisdictions in which regulation is perhaps not quite as important, and there are some very large exchanges operating in those jurisdictions that deal in derivatives. To what extent could that distort the market or help it?
At the same time, I like innovation, but when there's no regulation, I just don't like it. I don't like it because, you know, we've seen in crypto that the private markets, there's been a market failure in part from professional services firms to address the problems with transparency. I'm thinking about, you know, the stable coins that needed to be audited and they couldn't find an auditor. And so when you find that there's sort of market failure, that because it's a new industry, its reputation is maybe not pristine, then, you know, the normal ecosystem of financial firms, be they auditors, legal firms, etc., if they don't want to work with you, they're kind of screwed. You know, what can you do? And then we found that with Tether is the New York AG that stepped in and essentially told the industry what it was, and that yes, the funds are there. I mean, they ran into problems, but the funds are broadly there.
We were so surprised.
And I think that regulation is important because, you know, when there's such a failure, it's important that we know, well, this firm, I know I can rely on their statements, on their processes, etc., because they've been vetted by a neutral third party, which happens to be governmental and is not private.
Right. This isn't a comment on any specific projects or Tether or anybody else, but if you think about it, when regulators enter the space and enter the space in the way we have, you know, we're manning the wall, so to speak. So I'm not going to go all Jack Nicholson on everybody, but it's important that we're there because, you know, as retail comes in, if retail continues to be harmed, that's really detrimental publicity that this industry doesn't need. And for institutional investors to come in, they also want to see the regulator's presence.
And Matt, you as well as B2C2, you also work, you're an institutional focused business, so how can the institutions affect the retail market?
Well, so our target clientele, generally speaking, is institutions as far as aggregators. So again, being more precise about the definition of the term. Our market will be available through intermediaries to everybody. And so one of the things that we're excited about is, so going back to some of these common themes, there's other asset classes have come to almost take for granted the fact that there are exchanges that have oversight, that have robust policies and procedures, that are performant, that are reliable. These are things that we don't talk about in other markets, let's say. And so one of the things that we think there's an opportunity to do is to establish that in the crypto markets, and then by extension to allow maybe some of the more traditional players that do provide access type services, so broker-dealers, FCMs, at least in our case and with the futures market, that then can provide access to the asset, to trading in the asset, in a way that's very familiar and something that the investment community has seen before and is accustomed to. So if you can trade crypto alongside other assets, whether those are equities or options or futures contracts, we think that that's really interesting and something that up until now has been missing in the market. So when that foundational infrastructure is in place and it's reliable and we don't talk about it anymore, it's available to everybody.
Yeah, it's very true, and it's probably not that far off either. It'll be a fascinating space to watch, the evolution of derivatives in the crypto markets. I thank you all very much for joining us. I'm sorry we don't have more time because there's a lot more to talk about. Thank you all for joining us today, and I hope you enjoy the rest of the conference. Thank you.